It's the year 1720. London is buzzing with excitement. Merchants, aristocrats, even housemaids are pooling their savings, all chasing the promise of unimaginable wealth. Shares in the South Sea Company are skyrocketing, fortunes are made overnight, and just as quickly destroyed. This is the story of the South Sea Bubble, one of history's most infamous financial crashes. To understand the bubble, we need to step back. In the early 1700s, Britain was buried in debt. Endless wars against France and Spain had left the government owing tens of millions of pounds, a staggering sum at the time. Enter the South Sea Company. Founded in 1711, it was designed as a clever solution. The company would take on government debt, and in exchange, it was granted lucrative trading rights in South America. The problem? Britain didn't actually control South America. Spain did. Which meant the company's supposed monopoly on South Sea trade was more fantasy than reality. The company did have the right to trade, but on harsh terms and would not be able to make much profit. But perception often matters more than reality in finance. Investors were dazzled by the idea of a grand overseas trade empire. Parliament gave the company its blessing, and high-ranking officials, even King George I, took shares. That royal seal of approval sent excitement through the markets. In 1720, the company proposed a bold plan. It would assume nearly all of Britain's national debt in exchange for issuing more stock. Shares began at about £130 each. But by the summer, they peaked at an astonishing £1,000. Everyone wanted in. Coffee houses in London were crammed with frantic buyers. Ordinary people sold their homes, pawned their belongings, or borrowed money just to buy shares. Other speculative ventures piled on. Companies promised wild ideas, an air pump for the brain, schemes for extracting silver from lead, even a machine gun with square bullets. And yet, investors still gave them money. That's the fever of a bubble. Logic goes out the window. By autumn of 1720, cracks began to show. The South Sea Company had promised vast profits, but real trade revenues were tiny. Savvy investors started cashing out. Confidence wavered. Prices stalled, then collapsed. From £1,000 in July, shares fell to £170 by October. Anyone who bought stocks late was ruined. Families who dreamed of riches were left destitute. It was financial devastation on a national scale. As the wreckage became clear, the British people demanded answers. It turned out company directors had bribed politicians and manipulated stock prices to keep the bubble growing. Members of Parliament were implicated. Even ministers of King George I faced disgrace. The government scrambled to stabilize the economy. The Bank of England reluctantly stepped in. South Sea directors had to surrender their fortunes, though ordinary investors saw little relief. The South Sea Bubble wasn't the last financial frenzy. From Dutch tulip mania in the 1600s, to the dot-com crash of the early 2000s, to cryptocurrency booms and busts of today, the same impulses appear again and again. The South Sea Bubble highlighted the dangers of speculation, the need for financial regulation, and the risks of letting dreams outpace reality. The South Sea Bubble reminds us that financial markets are not just about numbers, they're about people. Our hopes, our fears, and our willingness to believe in something too good to be true. In 1720, Britain learned that lesson the hard way. And perhaps, nearly 3 centuries later, it's a lesson we're still struggling to learn. Thanks for watching. If you found this video insightful, don't forget to like, comment, and subscribe. This is the Hobby Historian, signing off.